McDonald's is a large, legacy restaurant company, but is this stock a buy right now? Welcome to the Food Fund. Can McDonald's continue to be a steady grower? If you own McDonald's, or you're thinking about it, you need to watch this video. I'm excited to dig into the fundamentals, but let's start with the price action. Over the last year, you're looking at a decent 8% CAGR. Zoom out to 5 years and it's an 8% CAGR. It may not be a rocket ship, but McDonald's has pretty reliable price appreciation. Market share is a key factor for restaurant companies. The dashboard shows McDonald's is the second largest fast food restaurant company, just behind Starbucks, but it does not seem to be growing. Looking closer, McDonald's has a 3.16% share of the market among public food, beverage, and restaurant stocks. Over the last 5 years, McDonald's market share has actually contracted at a 0.3% CAGR. They've gone from 3.19% in 2021 to 3.16% today. The good news is that after bottoming in 2022, McDonald's has steadily grown their market share. The bad news is that today's market share is still smaller than that of 2021. This is not good. Now let's explore the fundamentals for more. Gross margin is 57%. This is excellent for a fast food restaurant. Revenue has grown at a 3% CAGR over the past 5 years, now at $26.1 billion. Slowly and steadily, McDonald's is growing their revenue. Now let's look at cash flow. Operating cash flow increased at a 2% CAGR. CapEx worsened at an 11% CAGR. The result? Free cash flow declined at a 1% CAGR. CapEx is clearly the culprit here. McDonald's is investing heavily to try to grow their brand. Weighted average shares outstanding have decreased over time, going from 751.8 million shares in 2021 to 718.9 million shares most recently. McDonald's has done a great job of buying back shares. This is what shareholders want to see. Next, return on invested capital. This tells us how efficiently management has used capital from investors. Going from 17.4% in 2021 to 17.1% most recently, management has actually gotten a little less efficient in deploying capital. For operational efficiency, measured by the cash conversion cycle, McDonald's is doing very well. Going from 3 days to minus 71 days, management has done a great job improving the efficiency here. Finally, debt. Net debt to EBITDA has risen just slightly from 3.6 in 2021 to 3.8 most recently. McDonald's has essentially kept its debt load manageable. McDonald's seems like a fair company. What quality score would you give the company? Before I share my score, let's compare McDonald's performance against the gold standard, the S&P 500. Investing $10,000 in McDonald's would have grown the investment to $32,031, compared to $36,399 in the S&P 500. That's an annualized return of 12.9% for McDonald's versus 14.4% for the S&P 500. McDonald's also had just slightly higher volatility. Risk-adjusted returns, as measured by the Sharpe and Sortino ratios, were worse for McDonald's, but not by much. Though investors were better off owning the S&P 500 instead of McDonald's, there were a few times in the past decade when McDonald's outperformed the market. McDonald's was founded in 1940 by two brothers who later sold the business to Ray Kroc. Kroc transformed the business from a single California restaurant into the global franchising powerhouse it is today. With the iconic Big Mac and its world-famous fries, McDonald's serves millions of customers daily. The company is headquartered in Chicago and has a total of 150,000 employees. Despite its stability, McDonald's days of growth are behind it. Based on my proprietary scoring system, I give McDonald's a 4 out of 10. Still, McDonald's may be a good investment for a select group of investors. Before I share my final thoughts on that, if this analysis was helpful, please hit that like button to let YouTube know. It really helps the channel. And if you want more deep dives into food, beverage, and restaurant stocks, subscribe and ring the notification bell so you don't miss the next video. Your support means the world to the Food Fund. Also, don't forget to turn on your notifications if you are watching on a mobile device. So my final thoughts on McDonald's. Let's write it out in the spreadsheet. It is a restaurant company with a gross margin of 57%. The 5-year revenue per share CAGR is 5%, and the 5-year free cash flow per share CAGR is 0%. Though the margin is great, growth is clearly subpar. A return on invested capital of 17% is not bad, but it is falling. Next, The cash conversion cycle of minus 71 days is excellent, though I'm not sure how long this lasts. A net debt to EBITDA of 3.8 means that it would take McDonald's nearly 4 years of earnings to pay down their debt. That value is in line with the rest of the industry. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, is 3.6, indicating that McDonald's is overvalued relative to its expected earnings. McDonald's is no longer the fast-growing, super popular restaurant company it once was. Rising input costs and lack of innovation have stagnated growth. That said, investors seeking low volatility will be rewarded with steady dividends. For me, there are higher quality and more growth-oriented companies out there. The opportunity costs of investing in McDonald's don't quite align with my portfolio right now. Maybe someday in the future they will. Thanks for watching. What do you think about McDonald's? Share your thoughts in the comments below. I always love hearing from you. Check out some more videos right now, and remember to put your money where your mouth is.